Welcome, everyone, to one of the best events you will ever attend in crypto. This is my, I think, probably the third time at Tokenized Capital. I always have a great time. So thank you all for joining. And you will also meet some of the most highest quality speakers, panelists, professionals in the industry right here. So first to start, I'm Will. I lead strategy and BD at Caladan. We are a quantitative trading firm, been around for about 8+ years, started by traditional finance traders. And we've navigated this space for 8+ years. It's been quite a ride. And seeing it evolve continually and bringing in more experienced practitioners, people from all walks of life, people from all these different perspectives across hedge fund, VC, banking, fintech, it's impact investing, et cetera. It's a volatile market, but so vibrant. So, never been a better time to be here. Yeah, I'll let the rest of the panelists introduce themselves.
Yeah. Hey guys, we came over here because they say this is actually the panel where people actually listen, right? So it's actually the first panel starting from consensus for us. By the way, my name is Michael. I'm the co-founder and the vice chairman for C1 Fund. We are a New York Stock Exchange listed closed-end fund providing public access to the best private digital asset companies. Thank you.
Hi everyone, my name is Gerald. I'm from Sygnum Bank. Sygnum is the world's first digital asset banking group. We were co-founded in Switzerland and Singapore. And we operate globally under a Swiss banking and security dealer license. We have 7 licenses in Singapore and licenses in other markets in the world. We were founded with the mission to empower everyone everywhere to own their digital assets with complete trust. And I think during turbulent times like the ones we are seeing in the markets right now, I think that promise has never been more relevant. We're very fortunate that collectively today we work with over 2,200 clients, some of whom are in the room today, so thank you for your support and trust. We focus only on working with institutions, corporates, high net worth individuals, and other regulated financial institutions, and collectively we help administer more than $5.5 billion US in assets for them. So thank you very much, Will and the panel panelists. Looking forward to the healthy discussion today.
Hi guys, my name is Pieter Dalstra. I'm a CIO and co-founder of Recursive Systems. We run a regulated market-neutral hedge fund in the Netherlands, where we specialize in the carry basis trades, liquidity provisioning, but mostly emphasize on active liquidity strategies like AMM LPing and other JLP strategies.
Hi everyone, Tom Krol from LM5 Capital. I'm the CEO and co-founder, also from Amsterdam, where our HQ is. I actually live in Malaysia, where we have our second office. We have a very mixed team, a team of 9, mostly traditional finance background, combined with people who've actually worked in DeFi, venture capital, investor base from all over the world. And yeah, also market neutral, focus on no drawdowns, stable returns. And happy to be here today and be part of this panel.
Yeah, thank you. Hey everyone, my name's Taran, also from the UK. So I flew in, I think, maybe 2 or 3 hours ago, so currently surviving on coffee. I'm with Kula. So Kula is an impact investment firm. We invest into different assets around the world. And what we do, whilst offering financial returns to investors, or at least aiming to, we also provide social impact and environmental impact to the local communities that exist around the assets that we invest into. So yeah, very much looking forward to the conversation. And Will, thank you for hosting us.
I'm Charles, the founder of Capital Investments. We're a directional hedge fund, so a bit different to the market neutral guys here. We hold positions for days or weeks, been trading crypto for 6 years, but also now equities, commodities. We take a systematic approach, work with investors around 28 countries, over 55% CAGR over that time, and pleased to be chatting with everyone here today.
Wow, look at how impressive this group is, right? Okay, I'll start off it's 2025, 2026 has been really challenging. I think a lot of sitting from my seat at Caladan, a lot of strategies that used to work really well don't work so well now. So a lot of our time is spent finding new opportunities, and also just catering to our partners, our clients, et cetera, because we also have to understand when it comes to LPs, when it comes to various partners, family offices, et cetera. There's one thing to create strategies. The other is to tailor something that fits other people's profiles. So I wanted to hear everyone's perspective on how are you navigating this time of change? Or how are you adjusting your business, if you even need to? Where do you think the opportunities are, whether it be for new strategies, products, that will really help invigorate the space this year? Feel free, anyone, please take.
Yeah, no, it's definitely been a brutal year if you purely look at on the long side. I think if you were a directional fund, there was quite some volatility there. So for you guys, I think shorting was definitely an opportunity. But even also in the market neutral strategies that we run, there were still opportunities. You know, you could arbitrage on funding rates, on price even a little bit. You could provide liquidity to protocols. You could do bootstrapping deals, point programs. So there was definitely a lot of opportunity there. I mean, last year we grossed 28% with no drawdown. So opportunity is still there. But it's becoming more challenging. You have to be really top on the market, looking for opportunities. And if it's no longer working, you have to roll them over. If you're going to stick to your initial strategy, like we did a lot of cash and carry trades in the beginning. But then you have the likes of Etina, Falcon Finance, and the whole funding rate game is kind of gone. They made it very efficient. So you have to keep on evolving and look for new strategies. And they will come, with the RWAs and bringing private credits on chain and stuff like that. So there's definitely opportunity, but yeah, you have to keep looking for it.
Yeah, I just add, I think the bar is like infinitely higher now in crypto for anything you want to buy and hold, because especially in the last, since inception really, there's been flooding amount of tokens in the market, but the last 2 years it's gone exponential with pump.farm, and you just got infinite tokens, so you get supply saturation in the market. So the only projects that really have any chance of survival are those that are growing with revenue basis. They have really strong tokenomics. They don't have supply cliffs unloading. So that if you look for those criteria, there's very few that meet that. Hyperliquid might be one. You could say BNB is when they burn their tokens as well. So I think the standard's way higher, and it's a bit of an uphill battle for most of these projects.
I would like to underwrite what you guys are indeed saying. Like, the volatility is characteristic of this market, but also within the market, these dynamics change so much, where at the beginning of the year, with Trump nomination, funding rates have been through the roof. Everybody set up only to a couple of months later, crypto being dead with the tariffs drama. And as a portfolio manager, you also really have to be flexible in your strategy suite. So where in the beginning, in November, funding rates being over 100% for almost a month, for a couple of weeks, then the leverage basis trades or liquidity provisioning strategies are really making killing. But if you hold onto these strategies in Q1 with the tariffs, you're just going to get bled out due to funding rates. So characterizing the market, knowing when to deploy which strategies and being nimble is something portfolio managers really increasingly have to manage. Also, likewise, in the mini bear market of the tariffs, if you then go too hard on hedging strategies with funding, you're basically getting bled out. Conversely, if you adapt and have your indicators set well and know that liquidations are more prevalent in these environments, and buying DPEGs or buying liquidations on chain, you can still really perform very well. So having a clear suite of strategies and knowing which strategies perform best and capitalizing on this, that's the new role of investment manager these days, I think.
I think it's actually quite easy to be a good portfolio manager, right? Because during the bull market, you talk about return. And during the bear market, you talk about risk. So I think given what happened for the last 1 month, right, it's about a good time to talk about risk. I don't know how many of you guys actually wake up during the night, and the first thing you do is to open your cell phone and look at the Bitcoin price, right? Or you go to the restroom, the first thing you do is also look at Ethereum price, right? I think I for one thing, sleep tighter than Michael Saylor, right? So we don't really leverage a lot, right? And when talking about managing risk, there's a lot of people, either retail investor or institutional sophisticated investor. There's still FOMO, right? 2025 is actually a good year. Everyone's kind of a jump on the bandwagon, investing in everything and making money. And now people worried. And they're worried not because they don't think they get in at the right level, because they're worried they don't know what they are investing, right? So I think it's actually when the market is going through a volatile situation like right now, it's really, really good to think about what are you really investing, right? If you are investing in something that is not just for return, are you still gonna investing on that? Is this the investment that actually you're gonna sleep tight, not to worry about this, right? So I think it's actually understanding the risk is really relevant for a long-term return, right? Because being in a market for over 1 decade, right? I think the only thing that is growing is my weight and the gray hair, right? Every year there's 1 or 2 events like this where people feel like, wow, it's going to the moon, and then it's shit the fun, right? So I think understanding the risk and understanding what you are investing is very, very important.
I think.
Please.
Thank you. I think just on the conversation of risk as well, I think the last couple of years we've seen a clear direction towards institutional interest. So, topics that come to mind for me are stablecoin adoption, we've seen ETF inflows, we've seen tokenization as the big, hot topic. And I think on Kula's perspective, the very reason we exist, to be honest, is to kind of try and caveat a lot of that risks using infrastructure like blockchain. And I think what's particularly interesting is blockchain being used as infrastructure and not the product itself. I think, is it Will? Sorry, Charles. I think Charles just mentioned briefly as well about digital assets and, we're moving away from the very speculative era. I think that's going to be a lot more common going forward. And just coming back to your point about managing risk, I think as, from Kula's perspective, it's important to, of course, be diversified, not just in asset classes, but also geopolitically as well. But I think regulation also plays a massive part into how companies are operating, particularly for us, just because we're literally investing into tangible assets like, for example, limestone mines, gold mines, hydropower, and so forth. And so, yeah, I think diversification, of course, across many different verticals is really important.
As I think the only non-PM on this panel, I can share perhaps the client perspective, what we see from our client base. And I think unsurprisingly, in 2025, most of the clients actually had strong demand for yield-generating, more stable strategies. I think the desire for them was to get exposure to a more reliable and predictable stream of returns rather than take more speculative bets. And so consequently, at the bank, we have asset management as a core part of our suite of offerings. In fact, in Singapore, we received the asset management license in October 2019. I've been running a variety of strategies from a multi-manager fund as well as a VC fund. And we also have licenses in other jurisdictions to do asset management. So we have about 8-9 funds that we manage, a few hundred million of AUM for. And the funds that saw the most success were the yield-generating ones. Both yield in fiat as well as most recently Bitcoin native terms. So we launched a Bitcoin Alpha Fund in Q4 last year. It was the single most successful fund launch in our history. We were oversubscribed for our seed tranche at 50+ million US, probably like 2 weeks after we launched. We continue to see inflows. And again, the fund seeks to generate a market neutral yield on Bitcoin using a range of the strategies that the folks on this panel also discussed, basis rate, but also cross-exchange arbitrage strategies. So I think there still is a demand for more yielding market neutral type strategies. And then on the other front, as a bank, actually we also had a lot of success on the lending side. So we provide Lombard loans, so we accept client crypto as collateral and offer fiat loans against it. We have had a loan book running now, I think now 7th year. we've grown our loan book to in the hundreds of millions, and we've never had a loss from our loans, right? We never had to take a write-off from our loan books, which I guess speaks to the risk management approach and the more conservative lending standards that we have. But over the last year, we've seen a lot of demand from hedge funds, from family offices to actually syndicate these loans. So we did about 50 million US of a loan syndication last year. We took those loans off our balance sheet, and we delivered for the loan investors, I think SOFR plus 400 plus basis points of return. So we, about 8.5 to 9% annualized return on those loan portfolios. So I think that kind of demand is something that has helped us weather and our clients weather 2025, which otherwise was, I'm sure the panelists here agree, a pretty brutal year overall for Delta One strategies in particular.
8+% returns. That's in this environment is super impressive.
I heard 20 something and 50 something, so I don't know.
28. No drawdowns.
Different risk profile. Actually, to expand on that, it's at the end of the day, all these strategies are catering for a need. Talk about demand. I think the demand for crypto products or financial products, it really is a question of, well, who are you going after? Are we targeting crypto native retail? Are we targeting family offices? Are we targeting the large institutions, the BlackRocks of the world? I'm actually very curious how you guys think about that, because depending on which capital base you're looking at, your strategy as a business is very different. So would love to hear how all of your perspectives on this.
I think you can do both. And the reason I thought, it's really interesting you say that. When Kula first started, we had quite a strong inclination towards Web3. And I think the line between Web3 and Web2 has really developed over the past couple of years. And one saying that we have internally amongst a lot of us in industry is energy comes from Web3, capital comes from Web2. And going back to your question, I mean, for us, I think it's really important to bring in retail, and it's important to bring in a diversified retail because they'll then actually participate in your protocol. So in our case, if we have, for example, a limestone mine or if we have a gold mine, well, we want people then on the ground. We want people who are participating in decision making, who can actually then make a difference as far as decisions go. What's interesting then is that if you look at on the institutional side, a lot of the times, you're not going to invest into the product directly. You're going to either go through another wrapper or you're going to go through an SPV, etc. And so a lot of the time, especially on the governance side of Web3, when it actually involves decision making, you don't then include the institutional guys or women. And so I think you can very much do both. I do think it's a scale. And going back to the whole analogy of, I think, energy can come from Web3 and then capital can come from Web2.
Honestly, I do think you should make a distinction because the investor base just has different characteristics they're looking for. Speaking from a retail perspective, honestly, most people in the market are just chasing 10x's, buying illiquid altcoins to maybe get to a position where they would, at that point, really start about risk management and capital preservation, then really multiplying capital in a small time. Our fund really looks at the institutional client base as being the broader set of money, and with that, different characteristics come to play, as in the things we often hear is minimum 20 mil AUM, chief legal and compliance officer, and maximum 5% drawdowns per year. With being like a spot buy and hold strategy, Bitcoin can do minus 5% in a day, in an hour. Literally this week we've seen these kinds of wicks. And optimizing for stable returns and risk-managed products, I think there's the biggest opportunity because that enables you to be on the shelves of these different companies. So at some point, the bigger banks, in the Netherlands is the ABN, the ING, the Rabobank, they will at some point also look at crypto as more of as a yield-generating means, really. So being able to white label your product and being on the shelves of the ABN where they can push your product further along the curve to their client base, That won't happen if you have -5, -10% drawdowns in a month. Also, they have to respond to these different dynamics. So family offices, sovereign wealth funds, and even foundations who have a lot of Bitcoin stablecoins, they don't want to see their money diminish really, because then they can also pay their employees less, then their runway also evaporates. So really emphasizing on risk management and no drawdowns, I think will be the new way forward, where in the traditional markets you have the bonds being the stable returns, and then equities in the 60/40 portfolio adding to the mix. I think moving forward you will see similar kinds of products where, for example, the 60/40 will morph into a 80/20, where 80% is market neutral DeFi hedge fund strategies, for example, basis carry trades, arbitrage strategies, and add in 20% Bitcoin exposure, where in the bull markets, yeah, you have double yields basically, Bitcoin going up, the strategy is performing very well, but in the bear markets, the drawdowns of Bitcoin are made up by the upside of the market neutral portfolio. And if you balance this portfolio in a good way, let's say 80/20, 85/15, then you can, in my opinion, have best of both worlds and make new products for the new era.
Just to comment our panel, fellow panelists, besides calibrating different strategies for different investors, right? I think it's also good to think about how do we actually, through financial engineering, right, come up with new investment vehicles that complete the entire ecosystem. And that was actually from the get-go how C1 started, right? You know, we're actually the only public company listed on a New York Stock Exchange, a private closed-end fund listed on a public market, and that provide public access to private companies, private equity shares. Like everyone knows that there are the best companies in the digital asset space. You know, the Tether, the Binance, all the who's, but not everyone have access. And even though you have access, not everyone have the capital. So, you know, democratizing access to everyone, that was the good goal. And that actually is a new vehicle complementing the ETFs, the DAT companies. So I think we've been spending a lot of time thinking about not just to deliver returns, but how we can collectively work together to complete the ecosystem, where mainstream financial institution people will feel like this is an emerging technology and an emerging asset class rather than just a sprint.
I think just Michael on the comment on just having a different type of wrapper is probably actually the most answer to the question. I mean, if we just use an analogy and for marketing, you know, somebody's X profile will be very different to their LinkedIn profile, and that will be very different to how they then market on TikTok and Instagram. And this is exactly the same case with investment. And the way that, you know, the product can actually be the same, the way that it's packaged can be different. And so coming back to the analogy of Web 2 and Web 3, that's why I'd say for us anyways, just because, you know, we are talking I think from different perspectives as well, just based on what everyone's doing. But I think that's the answer. I mean, these wrappers exist for a reason, and I do agree that the product that you're offering to institutional clients is definitely different to what you'd be offering for a retail, but the product and the underlying infrastructure is still the same. It's just the wrapper or how it's perceived that can be different.
Maybe I'll just chime in, because as I mentioned, you know, we've been running asset management strategies in a regulated way since 2019, and we have a fund of hedge funds that we've been, you know, operating since that time as well. So we've had the courtside seats and watching the evolution and the institutionalization of the space. And to, you know, the points made by Peter and other panelists earlier, I think we've held that high. We've tried to hold a high bar in, you know, when we allocate capital to hedge funds. But when we got started 7 years ago, if we said, oh, you know, you have to use a regulated custodian to hold your client assets, and you have to be audited by a Big Four, you could not invest in pretty much in, you know, 99.9% of the space. I think that's changing right now. I think rightly institutional allocators are taking the same standards that they apply to other asset classes, and then making sure that those are equivalent, right, in the crypto space. I think it's long overdue, to be honest. If we had all these in place in other bull and bear markets, I think we would have avoided some of the losses, some of the dramatic collapses that we did witness. But I'm just heartened that this the types of questions you're getting now and having an operational due diligence questionnaire that you have to fulfill on top of your investment due diligence, I think it's something that will help bring this space to the mainstream. And I think we are all here positioning, many of us in the room, now almost a decade for this institutional opportunity, right? And I think it is upon us, and it's therefore incumbent for all of us, as leaders, as pioneers in the space, to really live up and hold ourselves to those higher standards. And then I think with time, we will see more inflows, we will see more market participation. Maybe not less retail. I still see retail going primarily for sports and meme coins, unfortunately. But from the institutional side, where the big money and the long-term capital is, we are definitely seeing a lot more interest converting into actually investments. So I am bullish about the long-term market opportunity for all of us here, actually.
Just to add some perspective from the Caladan side as well, it's just think about, in the early days of crypto, how you wrap the product, how you position the firm, the compliance standards, et cetera, in order for you to access capital was just very different. I mean, I haven't been in crypto for very long. It's been 2 years for me. When I first joined, I used to work at a bank, and I realized someone could sign an agreement and transfer you millions of dollars with no collateral, with very little due diligence. Those days are kind of over, as I think they should be. And realizing, well, in order for you to tap into these new, more sophisticated pools of capital, the bar is way higher. Like how you present yourself, the compliance standards are way higher. I think you just put it very practically. A large amount of capital that if we want to interact with, has to go through a bank. I remember when we wanted to just purely look at stablecoin capital. Maybe the firms will. Maybe these large allocators will just convert to USDT and give it to us to run some product. The reality is no. Even though we can generate tons of yield, I mean, just to give a reference point, typically for all of our strategies, we're usually above 30+%. It doesn't matter because we haven't met the packaging requirements. So hence, the banking relationship is something that I've learned to have a better appreciation for, because if you don't have that right, you're not touching the capital. So just more broadly, just thinking about how we as a trading firm, we tend to focus much more on the strategy, the yield, which is of course crucial. That's the alpha right there. But then the distribution aspect and understanding the client base, that's I don't know if it's almost just as important, but we cannot ignore that. And as I think about how we tie back to Gamma Prime, ultimately what is this? There's many ways that Gamma Prime adds value, but I think about the access problem. It enables the star traders, star PMs who want to focus on alpha to be able to reach a broader audience. Again, coming from a banking background, I used to work at Prime and electronic trading at Goldman. To see the administrative and all the hurdles to package a fund in order to access the right audience is so intensive that most smaller funds, most managers, even no matter how good they are, will never be able to meet the hurdle. I think Gamma Prime is able to overcome that. For guys who are great at trading, but just don't have the access, that's gated by the banks, this is a platform for that. On the investor side, well, if you're trying to access private equity funds or hedge funds and you don't have at least $10 million, no one cares about you for most of the traditional world. Gamma Prime, I think, also solves that problem, giving access to the new aspiring affluent, early affluent. That's a huge base, but is unbanked. I think that's also an immense opportunity. So, but again, it thinks more about how, yes, there's the alpha, then the packaging, understanding the client base, and bridging all of that. That is what unlocks value. Sorry, I tend to go on a bit. I think the panel is almost wrapped up time. But final question, Just wanted to get a better sense of what is, all of you guys are leaders in your business, you're founders. What is your top priority for 2026 for your business?
Well, just to not to be cheesy, right? Should to deliver the maximum shareholder value, right? But it's good to see it's not easy to do, right? You know, you're talking about access, right? You know, on a much bigger process, right? I think the right access is really not relevant to the people in this room, right? I think you know, people thinking about like crypto doesn't really have enough liquidity, right? For the past 10 years, it's still that 2%, 3%, 5% of people chasing returns. And then you were saying that there's 2 to 3 billion people on this globe, right? Doesn't have access to basic banking, right? So I think the real beauty of crypto, on-chain finance, is really providing access to those people. Wealth creation is through capital income, not labor income, right? I work hard, you work hard. The people in Nigeria, they work hard. The people in Turkey, they work hard. The people in Indonesia, they work hard. But the salary income doesn't change their everyday life. It's the wealth creation through capital income. And that is the right access that crypto should be able to deliver to that people. Imagine if all those 3 billion of people actually have access to crypto via stablecoin to online finance, on-chain finance. And then we fix the problems of liquidity. And it's a lot easier for us to go through the turbulent market condition to deliver return. And when that day happens, I think that's where we can sleep tight, not to worry about the big return of withdrawal.
Oh, may I jump in?
Oh, okay. I think we have to go down to complete the panel. Yeah, so I mean, at Signum, we've been very privileged for almost a decade now to be working with many of the best and the brightest in the Web3 and digital asset space, including many in this room. I think we've set ourselves up to become that regulated financial market infrastructure that you talked about, Will, that was absent from the space in 2017, 2018 when we got started. And right now, our job just continues to do the boring work of keeping the plumbing running, right? Like last weekend, ensuring that we had 24/7 rails available for our clients to trade, and you know, sleep soundly at night, Michael, knowing that their assets would be there in the morning when they woke up. So I think we continue to do more of that, and we're looking forward to partner with many of you guys to continue to build this future finance together.
What I'm looking most forward for in 2026 is a couple of things. On the technological side, I mean, Hyperliquid is making quite some advancements in terms of products they're offering on the HIP-4 market and the HIP-3 market. Look at where it used to be out of the question that retail could invest in private companies like SpaceX, for example. Now, basically, you can long and short it on Hyperliquid. Lighter is adding it, and I can only imagine other DEXs being the first movers, including this, which enables retail investors, but also institutional investors looking for opportunities to bring it in their investment suite. For us, it also becomes more relevant because, yeah, I mean, for sure, at some point, we'll have SpaceX doing a merger, an IPO at a crazy valuation. Lots of funds want to get into the action. Lots of funds can't access DEXs, really. And these are actually ways retail can be earlier than institutions on very specific cases. For us, I mean, the day that IPO is going, I'm sure funding rates will be crazy on these DEXs. So knowing how to arbitrage or to basically short it, do a basis trade on these things. There are things that PMs have to be increasingly more flexible towards. Additionally, AI is, I mean, the ChatGPT moment was a couple of years ago, but now with Claude and OpenClaw and CloudBook, the advances are really happening fast. And I did not expect to still say this, that on a day-over-day or week-over-week basis, the game can already have changed, where first, operationally, you're not going to code anymore. An AI agent will do that for you. You have to also ask yourself, what is my role in this new technology? Everybody basically has to level up, think one abstraction layer higher, that I'm not going to code anymore. I'm now a manager to all these different employees / agents. And probably in a couple of weeks or months, they will also be a manager, and then you again have to level up one abstraction layer. But if you conclude that at the moment this all happens, basically you're too late. Now already you have to envision, just like VCs, what do they invest for? They don't invest in the solutions for the coming problems. They invest in the solutions that they invest in the solutions the future problems will bring with the current solutions. So also you just have to stay a couple of steps ahead, and that just takes time to really sit down and think about it. What do you optimize for?
I can be very brief, also because of timing. But focus for 26 is nothing different than the last 2 years. You know, we've been the best performing market neutral liquid yield fund in the space, applying institutional grade risk to this space, while generating stable yield and no drawdown. So we'll just keep continuing doing what we've been doing, and hopefully in the end of the year, again, we will be the best fund. So that will be our focus.
Yeah, I'll also be brief, but maybe just slightly different. 4 years ago, I actually find myself sleeping on a limestone mine in a tent, funnily enough, not your everyday in crypto. The reason for that was because that was one of our first investments. It was a limestone concession out in Lucas and Ghazi. And we shot an interview with one of the workers of the mines, and we asked the woman, if you could wish and dream, and if you could want anything, you know, what is it that you'd want? And she just turned around and said, you know what, I just want better roads so I can get to work faster on time. So, I mean, coming back to the question, you know, what do we want in 2026? I think we want to see a lot of our investments do good. We want to see financial returns. And then also we want to see and keep deploying capital into assets, into projects around the world, and then see us both a social and environmental impact to return as well.
For us, priority this year is pretty much the same as always, maximize returns within a risk-managed framework. I think, you know, we've been through a few bear markets and cycles as a fund, so a lot of that is about being fluid across asset classes. So we're utilising different asset classes. We've been doing that for the last couple of years to help manage risk. We also have our own AI trading strategy we've deployed in the last few months. So exploring these new technology avenues to try and deliver the best results for our investors.
Thank you so much, guys. Now, for the audience, if any of you want to learn much more about the various strategies, you have the founders of these funds right here. You're all taking capital, right? So please, let's give a round of applause.